Most investors are watching the stock market. They're watching AI stocks. They're watching earnings beats. They're watching headlines about the next big thing. But the bond market is moving in a way that deserves far more attention. Because when the bond market shifts, it does not just affect traders. It affects mortgage rates. It affects corporate borrowing. It affects government funding. And ultimately, it affects stock market valuations. Right now, the bond market is signaling something bigger. Not panic. Not collapse. But a structural shift. And if you ignore bonds, you are ignoring the cost of money. And the cost of money drives everything. Today we are breaking down what the bond market is signaling, why it matters more than most investors realize, and what this means for positioning going forward. The quiet shift in the cost of money. The United States now carries more than $38 trillion in federal debt. That number gets attention. But the real story is not the total. The real story is the cost. For more than a decade after the financial crisis, the US operated in an environment of extremely low interest rates. Borrowing was cheap. Refinancing was easy. Duration risk felt irrelevant. That era created habits. Investors became comfortable assuming that long-term rates would stay anchored. Governments grew used to rolling debt at minimal cost. Corporations levered up confidently. That environment shaped behavior across the entire financial system. But that environment no longer exists. Long-term Treasury yields are not sitting near historic lows. They have repriced. And that repricing changes everything. Because the 10-year Treasury is not just another number on a screen. It is the benchmark for mortgages. It anchors corporate bond spreads. It influences equity discount rates. When the 10-year yield moves structurally higher, the entire valuation framework shifts. This is not about a short-term spike. It is about a different baseline. And a higher baseline changes decision-making everywhere. Supply is no longer invisible. Now consider the supply side. The United States continues to run large fiscal deficits. That means more Treasury issuance. More bonds coming to market. When supply increases, something has to adjust. Either demand expands to absorb it, or yields rise to attract buyers. For years, demand was amplified by extraordinary monetary policy. Central banks expanded balance sheets. Quantitative easing suppressed long-term yields. Foreign reserve accumulation recycled global surpluses into US treasuries. That created a powerful absorption mechanism. But today, that dynamic is different. The Federal Reserve is no longer expanding its balance sheet aggressively. Foreign central bank buying is not accelerating the way it once did. Domestic investors must absorb a larger share of issuance. When absorption capacity changes, price adjusts. In bond markets, price adjustment means yield adjustment. This is not dramatic. It is mechanical. More supply, less automatic demand, higher compensation required. The bond market is reflecting that. The return risk pricing. For years, something unusual happened in bond markets. The term premium collapsed. The term premium is the extra yield investors demand to hold long-term bonds instead of rolling short-term debt. In calm, stable environments, that premium can compress. In uncertain environments, it expands. When inflation volatility increases, when fiscal trajectories become less predictable, when global fragmentation rises, investors demand more compensation for locking in capital long term. That compensation is reappearing. subtly but meaningfully. This is the bond market reintroducing risk pricing. Not crisis pricing. Risk pricing. That is an important distinction. Markets are not forecasting collapse. They are demanding compensation for uncertainty. And that changes long-term yield behavior. Why equity investors cannot ignore this: stocks and bonds are not isolated silos. Equities are priced using discounted cash flow models. Future earnings are brought back to present value using a discount rate. The risk-free rate forms the base of that discount rate. If the risk-free rate rises structurally, the present value of future cash flows declines. Even if earnings stay strong. Even if growth continues. This is why higher rate environments often compress valuation multiples. You do not need a recession for valuations to adjust. You just need sustained higher funding costs. This is where many investors become anchored. They focus on earnings growth. They assume strong earnings can offset everything. But the bond market sets the discounting mechanism. And discounting determines how much investors are willing to pay. Ignoring bonds while investing in equities is like ignoring gravity while building a skyscraper. It may work temporarily. The foundation matters. This is not about default. It is important to separate noise from signal. The US Treasury market remains the deepest and most liquid in the world. The dollar remains the dominant reserve currency. The bond market is not signaling default. It is signaling repricing. Repricing of duration. Repricing of fiscal risk. Repricing of inflation volatility. When the cost of funding increases, behavior adjusts. Governments face higher interest expense. Corporations become more selective with capital allocation. Consumers feel higher borrowing costs. This does not create collapse. It creates friction. And friction changes growth dynamics over time. The anchor to the zero-rate era. One of the biggest psychological challenges for investors is anchoring. For more than a decade, the dominant experience was falling yields. Any stress event led to lower long-term rates. The assumption became embedded: yields fall in downturns. Central banks will intervene. Long-term rates remain suppressed. But structural debt levels are higher today. Fiscal deficits are persistent. Inflation volatility has returned after being dormant. Geopolitical fragmentation has increased. The policy environment is more constrained. When debt levels are elevated, small moves in yield have larger fiscal consequences. Interest expense becomes a meaningful line item. That feedback loop matters. Anchoring to the previous regime can lead to mispricing risk in the current one. And those shifts often begin quietly. Another layer of this signal involves liquidity. When Treasury issuance increases significantly, it absorbs capital from the financial system. That capital is not simultaneously flowing into equities or private markets. This can tighten financial conditions indirectly. But because allocation shifts, higher Treasury yields can also make risk-free returns more attractive. If investors can earn meaningful yield in government bonds, the hurdle rate for equities rises. And that subtle shift in hurdle rate changes capital flows. The bigger structural forces. Demographics in major economies are shifting. Globalization is fragmenting. Energy transitions require capital. Defense spending is increasing in multiple regions. Sustained spending implies sustained issuance. If demand does not expand proportionally, yields adjust. What investors are getting wrong. Many investors still treat bonds as background noise. But the bond market often moves first. It reflects expectations about inflation, growth, and fiscal sustainability. When long-term yields move structurally, it is rarely random. The mistake is assuming that the old playbook always applies. The zero-rate era conditioned investors to expect support. But when the cost of money is no longer artificially suppressed, pricing becomes more honest. What this means for positioning: it implies that duration risk matters again. It implies that valuation discipline matters more. It implies that balance sheet strength becomes increasingly important. Companies with strong cash flow and low leverage have resilience. When risk-free rates are near zero, investors stretch for yield. When risk-free rates are elevated, selectivity increases. It is a regime recognition thesis. In some regimes, liquidity dominates. In others, discipline dominates. The bond market appears to be signaling a shift toward discipline. Stocks attract attention because they are visible and volatile. But bonds form the foundation. When the foundation shifts, everything built on it eventually adjusts. The bond market is not screaming crisis. It is quietly repricing risk. And quiet repricing can be more important than dramatic headlines. The signal beneath the noise. In a world with over $38 trillion in federal debt, the cost of servicing that debt matters. In a world with shifting global demand, absorption matters. These are structural forces. The bond market is integrating those forces. It is signaling that the era of ultra-cheap money may not define the next decade the way it defined the last. That is the bigger message. Final thoughts. If you want to understand where markets are heading, watch the cost of money. Watch issuance and demand dynamics. The bond market is signaling something bigger. And it is signaling that the assumptions of the last decade may not hold in the next one. Ignoring that signal does not make it disappear. Understanding it allows you to adapt.